Assalamualaikum and hi to Dr. Rafiatul Adlin. Today I would like to present the analysis of corporate financial performance, a trend and comparative study of Padini Holding Berhad and Parkson Holding Berhad. I would like to introduce my team members Nur HAZIRAH binti HAZIMI, Nur FATIHA binti HASSAN, Fatin AQILAH binti MISLIN, CAHAYA LAILATUL FATIHA binti HAMIDI. Introduction. The main focus of this report is to make a comparison report that can help to show the comparison between two organizations that are working in the same industry, which is Padini Holding Berhad and Parkson Holding Berhad. The report starts with background of both selected companies and highlight of financial performance that define company financial position with a historical trend within the market with 5 consecutive years. Let's go through with the company profile for Padini and Parkson. Padini Holding Berhad and Parkson Holding Berhad are two prominent retail companies that sell clothing and operate in Malaysia. Padini Holding Berhad is a leading fashion retail based in Malaysia, renowned for its high quality apparel and accessories. The company has established a significant presence in both domestic and international markets through its various brand and retail concepts. Their vision is to be a fashion company ever. Mission is to exceed customer expectation and our brand promise. Parkson is a prominent retail corporation based in Malaysia known for its extensive network of department stores across Asia. Their vision is to be Asia's leading department store group and mission is to inspire our people and to delight our customer. Financial history. As we can see here is statement of financial position for 5 years for both company which is Padini Holding Berhad and Parkson Holding Berhad.
Assalamualaikum and hello everyone. My name is Fatiha binti Hamidi. My student number is 2023289802 and I will represent for our net working capital, which is Padini has shown steady growth in its net working capital over 5 years from 503.98 million in 2018 to 726.86 million in 2022. This indicates strong financial management and effective liquidity. So for Parkson, however, experienced volatility after rising to 703.91 million in 2019. Its NWC turned negative in 2020, dropping into negative 1.87.85 million in 2021. Despite a slight recovery in 2022, the NWC remained negative at 313.57 million, indicating severe liquidity issues. So for our summary, Padini has strong financial health, continued effective management and explore growth. But for the Parkson, address declining NWC costs, improve liquidity management and consider financial restructuring. And for our current ratio that we can see from the graph, Padini current ratio improved overall from 2.93% in 2018 to 3.62% in 2022, as it was peaked at 5.40% in 2021, indicating strong liquidity and financial management. Nonetheless, Parkson current ratio fluctuated, starting at 1.18% in 2018 and slightly improving to 0.88% in 2022. It was dropped below 1.0 in 2020 and 2021, indicating significant liquidity challenges. So for the summary, for the Padini, it has a strong liquidity and effective management, continue robust practice and explore growth. But for the Parkson, we can see the weak liquidity improve and they can improve asset management and consider financial restructuring. And for the quick ratio, as it shown from the graph, Padini has a very strong and improving quick ratios from 2.93% in 2018 to 3.62% in 2022. It peaked at 5.40% in 2021, indicating robust liquidity and financial health. But for the Parkson, it's variable and generally lower quick ratios from 1.04% in 2018 to 0.72% in 2022. It was dropped below 1.0 in 2020 and 2021, indicating significant liquidity challenges.
Assalamualaikum and good day. My name is Nur Hazirah binti Hazimi and I will be presenting the activity ratio for Padini and Parkson holding Berhad for the 5 consecutive years. So the first activity ratio is account receivable turnover. As you can see the graph in the slide, this suggests that Padini collects payments from its customers more promptly than Parkson does. In 2022, Padini's turnover ratio increased to 23.36 from 21.61 in 2021, indicating a slight improvement in receivables management efficiency. On the other hand, Parkson's ratio declined to 6.09 in 2022 from 9.73 in 2021, suggesting a worsening trend in its receivables turnover, which may indicate challenges in collecting payments from customers in a timely manner. Comparing Padini and Parkson over the years, Padini consistently shows a higher turnover ratio compared to Parkson. It indicates that Padini is more effective in collecting the debts from the customers than Parkson. So next, we move to average collection period of both companies that have shown through the graph. Based on the average collection period, the shorter the ACP, the better, as the company is able to collect the debts with a shorter period, and it really shows that Padini is the better company in terms of managing and collecting receivables efficiently. The shorter collection period suggests better liquidity and cash flow management, making Padini a more attractive option from a financial efficiency perspective. Padini and Parkson over the 5-year period from 2018 to 2022, the negative values indicate that both companies generally pay their suppliers before the invoice due date, which is favorable as it reflects efficient cash management and good relationships with suppliers. Specifically, Padini's APP ranges from approximately negative 35 days to negative 75 days, indicating consistent early payments over the years. Parkson also shows a similar trend with APP ranging from approximately negative 210 days to negative 441 days. This suggests that both companies have been proactive in settling their payables promptly, which the longer the APP, the better, as it reflects the availability of cash in the company. In inventory turnover, it clearly shows that Padini consistently has the lower amount compared to Parkson throughout the period. A negative turnover ratio, as seen in some years for both companies, suggests either discrepancies in reporting or issues with sales and inventory data. For Padini, the negative ratios indicate that inventory may not be selling as quickly as it is being replenished, potentially leading to overstocking issues or slower sales. As for Parkson, although also showing negative ratios in certain years, generally exhibits higher turnover ratios than Padini, indicating a comparatively better inventory management efficiency. So shown in fixed asset turnover, Padini has a much higher average fixed asset turnover ratio of 5.95 times compared to Parkson's 0.58 times over the 5 years. This indicates that Padini is significantly more efficient in utilizing its fixed assets to generate sales compared to Parkson. Based on the fixed asset turnover ratio, Padini is the better company in terms of efficiently using its fixed assets to produce revenue. This suggests that Padini is more effective in managing its investments in fixed assets, which could lead to better financial performance and growth aspects. Over the 5-year period, Padini consistently outperforms Parkson in terms of total asset turnover. Padini's higher ratios indicate a more efficient use of its resources and assets to generate sales. Even though both companies experienced declines during the pandemic, Padini's recovery was stronger than Parkson. Based on the total asset turnover, Padini is the better company in terms of efficiently utilizing its assets to generate sales.
The debt ratio. Debt ratio measures the proportion of a company asset financed through debt rather than equity. Comparing Padini and Parkson over the year, Padini consistently showed lower debt ratio than Parkson. For instance, in 2022, Padini debt ratio was 20.35% compared to Parkson 72.42%, indicating Padini relies less on debt financing relative to its asset. This lower reliance on debt suggests Padini may have a more conservative financial structure, potentially leading a greater stability and lower financial risk compared to Parkson, which has consistently higher debt ratio. Debt to equity ratio is a financial metric that indicates the proportion of debt a company is using to finance its asset relative to its shareholder equity. Looking at the data for 5 years for both companies show varying level of debt relative to equity over the year. Therefore, from a risk management perspective, Padini lower debt to equity ratio indicates a relatively stronger financial position compared to Parkson, assuming other factors such as profitability and industry condition remain stable. Time interest earned. It measures a company's ability to meet its interest obligation on debt. A higher TIE ratio indicates better financial health and a lower risk of default. In this case of Padini and Parkson, both companies have consistently negative TIE ratio over the year, implying that their earnings before interest and tax EBIT are insufficient to cover their interest expenses. Comparatively, Parkson demonstrates a slightly better ability to cover interest costs, albeit still marginal, highlighting a potential edge cover Padini in financial stability despite their ongoing challenge.
So, Assalamualaikum, I'm Fatiha. So, today I'll be presenting the gross profit margin. As what we can see in the table, Padini have a very consistent gross profit margin above 37%. It demonstrates efficient cost management and profitability. For the Parkson, as what we can see, has faced challenges with negative gross profit margin, and it has issues with cost management and pricing strategies. In the conclusion, overall of the gross profit margin, Padini shows strong stability and profitability, and for the Parkson, it needs to focus on reducing costs and optimizing pricing strategies for improvement. Moving to the net profit margin, as what we can see in the table, over the past 5 years, Padini has shown effective cost management and profitability, with net profit margin starting at 10.61% in 2018 and rebounding to the 11.68% by 2022. But for the Parkson, it has faced ongoing financial difficulties with negative net profit margin starting at negative 4.26% in 2018 and slightly improving to the negative 7.18% in 2022. So in conclusion, Padini has maintained profitability and should continue its effective expense management, while Parkson needs to reduce costs and optimize revenue to improve financial performance. Now we are in the operating profit margin. As what we can see in the table, over the past 5 years, Padini has consistently shown positive operating profit margins, reflecting strong management operating expenses and operational efficiencies. In contrast, Parkson has faced negative operating profit margin, indicating struggle with operational efficiencies. What we can conclude from here, Padini has maintained strong operational efficiencies and should continue its effective practices. But for the Parkson, however, needs to focus on reducing operating expenses and optimizing process to improve financial performance. Over the past 5 years, Padini's return on asset showed a fluctuations, and as what we can see in the table, indicating improved operational efficiency and strategic adjustments. In contrast, Parkson faced persistent challenges with negative ROA figures throughout the period, as what we can see in the table. So, Padini has maintained strong operational efficiency and should continue its effective practices. Parkson, however, needs to focus on reducing operating expenses and optimizing processes to improve financial performance. Last one is return on equity. As what we can see, Padini return on equity showed significant variability from 2018 to 2020. However, Padini rebounded in 2022 with an ROE of 17.29% indicating improved operational efficiency and strategic adjustment that boosted profitability. For the Parkson, again, faced persistent difficulties with negative ROE throughout the period. Highlighting several operational challenges, although there was some improvement to negative 8.55% in 2022, Parkson continues to struggle with effectively utilizing shareholder equity. So we can see in their table. And what we can say, Padini demonstrated realizing with a rebound in ROE in 2022, showcasing potential for sustained improvement. In contrast, Parkson consistent negative ROE underscores ongoing operational and strategic challenges. Both companies need strategic management and operational efficiency to enhance profitability and create long-term shareholder value. Finally, the last part of the presentation is the conclusions. Financial ratio analysis provides a valuable tools for assessing a company's performance over time and comparing it with peers in the same industry. While these ratios enable management and analysts to evaluate financial health and trends, they can sometimes mislead if not interpreted correctly. Despite limitations in forecasting future performance, ratios serve a crucial references for understanding past business trends. Ultimately, the effectiveness of ratio analysis depends on aligning measurement tools with specific business objectives and stakeholder needs. Thus, its importance varies based on contextual requirement and the information needs of stakeholder. Thank you.